Good morning, everyone. It's now 10 o'clock on the dot, so we'll begin the webinar. My name is Lisa Kaplan. I'm the Associate Director of Sterling Private Wealth, and on behalf of our Sterling team, I'd like to welcome you to our May webinar, Markets Shaken, Not Broken. We've recently experienced high levels of global market volatility with geopolitical tensions, instability around oil and inflationary concerns, interest rate uncertainty, and much market noise. I think the key message that we'd like to drive home today is that volatility is an inherent characteristic of markets, and although it may not be comfortable, it's often expected, and we'd like to highlight the importance of diversification and long-term thinking. We are delighted to have two esteemed speakers sharing their insights and perspectives with us this morning. We have Ray Shapiro, who'll be giving us a talk on global markets, and Malcolm Charles, who'll be chatting us through the SA macroeconomic environment and fixed income. Thereafter, we'll have a short Q&A session. So please feel free to pop your questions in the little Q&A box, which has got a question mark at the foot of the screen. Ray Shapiro, who will be our first speaker, is the Chief Investment Officer of Merchant West Investments, the sister company to Sterling within the Merchant West Group. Ray has been with the company for over a decade, and he has extensive experience in global markets and portfolio management. We often refer to him in the office as the walking encyclopedia because he has immense knowledge on an incredible breadth of topics. He's responsible for a number of mandates with Merchant West Investments, but notably the Global Equity Fund that he manages has achieved top quartile peer performance since Ray took over management circa 5 years ago. Ray will be covering the global environment, and he's also touching on AI and market concentration risks. Thereafter, we will hear from Malcolm Charles. Malcolm is a portfolio manager at 91 Asset Management in the fixed income team. He manages a number of strategies and has 30 years of industry experience. One of these strategies that is key to Sterling and our clients are the diversified income strategies, which we utilize quite proficiently in our portfolio construction. Malcolm has been with 91 since 2001, and he too has extensive experience as a portfolio manager and specifically within the fixed income space. Malcolm will cover the South African macroeconomic environment, and I always find these insights fascinating because they directly impact us as South African consumers, investors, business owners, and households. Topics such as, again, geopolitical tensions in oil, inflation and interest rates, and South African bond opportunities. So, Malcolm, we look forward to hearing your insights in the latter part of the presentation. And Ray, you'll be kicking us off. Thanks, Ray. Over to you.
Thank you very much, Lisa, for those kind words. Hopefully I don't look like a walking encyclopedia. Hopefully it's just intangible. I'm just going to share my slides quickly. So thank you everyone for dialing in today. I was going to say from a stormy and rainy Cape Town, but now the sun has come out and it's a beautiful day. And isn't that just like markets? The 1 minute you think it's all storm and it's the end of the world and there's a war in Iran, the next thing the market's running again. So it's kind of like Cape Town weather, isn't it? I'm going to kick off with this first slide, and this is really just US consumer sentiment. And I'll just give some time to see the comic at the right top right-hand side. I don't think any president in history or any person has spawned more comics making fun of him than Donald Trump. But obviously Donald Trump thinks he's very popular, thinks things are going well, except that gas prices are really putting a dampen, at least on the American economy and certainly every other economy, including ours. What this graph shows is the University of Michigan Consumer Sentiment Index. And this is really how people are feeling. It's how they're feeling about the economy, how they're feeling about spending, and what their outlook is. So it's very much a forward-looking sentiment indicator, and we can see it's very low. That light blue line is in fact at the lowest level since this index has been in existence, which is 1978. I don't go back to 1978, but it is at the lowest level since its creation. So that is definitely something to think about. And we've just overlaid oil prices. Oil prices are inverted. So obviously as the black line goes down, that means oil prices are high, at $110, $105 a barrel. But we can see how closely they correlate. So Americans are very, very sensitive to oil prices, and especially the US consumer. Why is that important? Because the US consumer is the single largest driver of global GDP, of global demand. It is 15% of global GDP, and approximately 70% of American GDP. Of course, America, being the largest economy in the world. So these things are important. It's the lowest level on record thanks to oil, but maybe we should also say thanks to Trump. But of course, the market forgot to ask the consumer. We can look at consumer sentiment, but now we look at the S&P 500, the US market, and it is, it's up strongly, as we know, over the last 5 years. However, even over the last year, it took a bit of a dip on the Iran war, but it has bounced back very strongly, almost from the 30th of March exactly, which is very interesting because if you look last year, we had a big drawdown and we had a webinar at that stage. I think we timed the bottom to perfection where we said drawdowns like this are great buying opportunities, and it turned out to be a great buying opportunity, as did the 30th of March this year. But now, how is this possible? Markets are at all-time highs. They're up pretty strongly this year, but the market is ignoring the consumer, which is the biggest driver of global demand. Why is this? And this is really the major reason. It's a $1 trillion AI arms race. And as we can see, these are trillions of dollars, and this is the hyperscaler and neocloud capex forecast. This is what all Amazon, Google, Meta, Microsoft, Oracle, they are spending and forecast to spend trillions of dollars each year to build out AI capabilities. And I'm sure we all know what AI is. We're all using AI, and that AI comes at a cost. The point to make here, if someone's spending trillions of dollars, there's a whole lot of people who are making trillions of dollars, maybe not individually, but as a group. So we can see this is really what is powering markets at this stage. Now, if we look at just in terms of returns, and this is the last 12 months, I would say looking over the last 12 months and even year to date, it would have been much better just to ignore the news headlines. Would have been better. Don't read the paper. Don't follow the Iran war. I confess I did and I do, but it would have been actually better to not do that, because over the last 12 months, global markets, that's the MSCI All Country World Index, is up 26% in dollars. Energy, unsurprisingly, is up 36. You might have expected it to be up a bit more given all the conflict in the Middle East. However, semiconductors are up 115% over the last 12 months. And in fact, a lot of that gain, almost 70% has come year to date. They took a bit of a dip, but 115% over the last 12 months. And this is really what is driving markets. We can see the flip side of that has been software companies. That includes Microsoft, Salesforce, SAP. Over the last 12 months, those are down 16% on disruption risks. A lot of people believe that all these AI advances could seriously threaten a lot of software names. However, the real market driver is semiconductors, surprisingly, and not necessarily energy. And just to ram the point home, semiconductors are part of the picks and shovels of the AI, what we can call it, revolution. I think there's no doubt AI is going to have a very significant effect on the world. And what this chart shows is that the world semiconductor market cap over the world index. So how big are semiconductors in the context of the value of all companies in the world index? And they have grown to a massive 16% of the world index. They are now a very big market driver, and it's not just about size, it's about how much they're going up. Now, if you go back a few years, to 2018, even, they were only 4% of the world. Further back, 2007, they were 2%, and now they're 16%. This is an unbelievable jump up. Even in the last year, they've gone from 8 to 16. I don't think I've ever seen an index weight double like this before. Now, if we move on to the next slide, just to really give you some specifics, and this is Berkshire Hathaway's market cap. It's over $1 trillion. We all know Berkshire Hathaway. We all know Warren Buffett. But what is this black line? So it's Berkshire versus who? This is a company, South Korean company called SK Hynix. A year ago, Berkshire was 14 times the size of this company by market cap. Now they are almost the same size by market cap. So that is absolutely astounding. It took Warren Buffett over 60 years to build this company. SK Hynix hasn't been around nearly that long. It's up 766% in a single year. That is totally crazy. What do SK Hynix do? They basically produce memory chips, advanced memory chips, what had for many years been seen as a really commoditized industry. I'm talking about the memory chips that go in like your flash disk and things like that. They do it on an industrial scale. But what's happened due to the AI revolution is that there's a huge demand for memory. Despite it being a commodity, the demand has exploded in a single year, and there's not enough supply. To just further emphasize the point, the extreme moves in semi-memory names. If you thought SK Hynix at 766% was a lot, you haven't seen anything. Because SanDisk, yes, it's the same SanDisk that make that irritating memory stick that you go and buy at Incredible Connection or somewhere else. That is up 3,357%. And that is just in the last 12 months. Western Digital, I've got a Western Digital external hard drive, which I never use anymore because everything's in the cloud now. And that's up 897%. Semi's up 115, and global markets at 26. That don't even look like anything. So, all these companies, they're all the shovels for the AI race. So it's like, don't dig for gold. Forget about your large language model. Just sell these guys shovels. And this really makes a gold rush look tame. And the question is, one of my worries is, if things go up very quickly, they can usually go down very quickly. However, these companies are up a very significant amount. And the question is, how long can it really last? Of course, these a kind of underappreciated knock-on effect of the run in memory names and AI in general has been how well emerging markets have done. So obviously South Korea, which is where things like SK Hynix and Samsung, which is also up a lot, are listed. That's up 95%. Year to date. So that is, that's only a few months. Taiwan up 51%. Of course, that's a home of TSMC, Taiwan Semiconductor Manufacturing Company. But other markets like Turkey, Israel, emerging markets, Asia, Brazil, Thailand, these markets are also up quite strongly, and a lot of them supply other inputs, into AI. So I think, could this be the return of emerging markets? We can see earnings per share growth has really rocketed. But I have to point out, and I'm not one of these perma bears, but what this is this reminiscent of the dot-com era? And if we look at the market weight of technology in the dot-com era, that was 1998, 1999, 2000, it got to well over 25% of the world market cap. And Well, it got to approximately 25%, and now we're over that. So that's on the left-hand scale. So we got to 25%. Now we've blasted through 25. We had about 28%. And just for context, world staples at that time dropped to approximately 12% of the world market. These are boring companies, Nestle, Procter and Gamble, Coca-Cola. They have now dropped to approximately 5%, and that's on the right-hand scale of the world. So it kind of looks like, could it be the dot-com era? We don't know. We don't know if it is or it isn't, but I would just advise some caution because there is well and truly, when things are going up 3,000%, 800%, that is a form of hysteria. I'm not saying that AI is a bubble or anything, but in certain stock things are looking frothy, to say the very least. I will point out that Berkshire Hathaway's cash levels are at an almost at an all-time high, as long as I could find, at least. We're sitting at almost 40% cash, Berkshire Hathaway, as a percent of their market cap. I mean, that is absolutely huge. It's probably at about 38%. That is higher than just before the global financial crisis. So the greatest investor ever, despite stepping down as CEO, he's still involved in investment decisions. He is holding a lot of dry powder. What we do know is quality has lost a bit of its flavor and favor recently. This happens when investors are chasing hot AI stocks. So a lot of quality companies that aren't really related to AI, have lagged because AI is sucking a lot of the capital away from other companies, and everyone wants to chase AI names. So there has been an underperformance recently. And if we look, a very interesting aspect of the MSCI Quality Index. So this is a passive index of quality stocks. And if we compare it to that passive index of growth stocks, which is the MSCI Growth Index, here are the top 10 names. So we find a very weird kind of similarity, is that the top 10 stocks of the Global Quality Index, this is a passive index, and the Global Growth Index are actually very similar companies. They're semiconductor companies, they're hyperscalers, they're big internet companies. So there's a lot of, it's become different in a passive sense to differentiate between a growth index and a quality index. And that's why I would emphasize that when in quality investing, stock picking is absolutely essential. Otherwise, you might find yourself exposed to a frothy, overhyped section of the market. Not saying you own no tech companies, but I think it's very, it might not be wise to own just the global quality index. But you can see the quality index has underperformed the market despite owning a lot of these names. However, I think there's a bit of a curveball that could be thrown at us at the US midterm elections. It's best not to forget Trump, but what we do know is that Trump's net approval ratings on a whole lot of issues. Let's not forget that I think we can pretty much blame this oil crisis on Trump. I think if he hadn't got involved in Iran, we wouldn't have these oil prices. But his net approval ratings, and these are net ratings across multiple polls. There's dozens of polls that the producer of this graph, Nate Silver, uses, so it's not really skewed, it's controlled for bias. That the biggest issue is inflation. Americans are hating this high fuel price, as we all are. They're worried about the economy. -24 net approval rating for the economy, -20% for trade, -12% for immigration. All Americans are really hating this, and they've potentially got their knives out. As it stands, the odds are for the Republicans to lose the House of Representatives. And this could be very interesting. It could clip Trump's wings. And it would certainly be good from the tariff scenario. I would say historically it's actually been good news for equities, but we really don't know what is going to happen. But I think we could see a gradual retracement out of things like Iran, because if you're worried about politics, it's all about the economy. And I think Trump might just have to rein in some of his rhetoric. So this is in November, and this could change a lot of things going forward. So this is something that we are watching. And I will stress, a lot of stocks that aren't AI related have actually underperformed due to the AI stocks sucking up a lot of the capital. And I think a Trump Funnily enough, well, I won't say a Trump, but a Republican loss of the House could actually be very positive for these stocks, especially, if they've had a tariff fear hanging over them, or if they've had a regulatory fear hanging over them, such as healthcare stocks. And with that, that is my last slide. And thank you very much, folks. I'm going to hand over to Malcolm now. Let me just stop sharing. Thank you very much for your attention.
Thanks, Raymond. Thanks very much. Good morning, everyone, on this rather pleasant Tuesday morning. So I'm just going to take you through a little bit more. You've had a fantastic worldview from Raymond, and sort of what to expect and what to fear, and what to worry about from a global perspective, which is probably what has been keeping us awake this year is the global factors. So I'm gonna drill down a little bit more into South Africa, what we can expect going forward. We've got quite a busy year as a country, a lot of political noise of late, and obviously the big local government elections at the end of the year. So I'm just going to take you through what has happened, what the way we are looking at the world, and what we can sort of expect from some of the outcomes from the war, which is obviously the dominant factor. So it's been a crazy couple of months since the war started, the war that was meant to be 2 to 3 weeks. We went into the war in a very good space, thankfully. South African growth was on the up, momentum was very good, investment was good. We were seeing very good inflows into both the equity market and the bond market. Rand was behaving extremely well, and it actually rallied, one of the best performing, I think it was the fourth or fifth best performing currencies last year. Inflation completely under control. The fiscus, National Treasury doing a fantastic job. So at least when we went into this war, it's the best we've gone into a crisis in probably 15 years. That's the good news. The bad news is that there's not much we can do about this war. We are a bit player, and we've got to bob and weave while it happens, and we're very much a price taker when it comes to oil. As we've all noticed when we fill up our cars, it's become quite a horrible experience. I think the message from this slide is it's a crazy world out there, but markets are forward-looking. And I think the moral of the story is don't panic when it happens. I think you've got to panic before, but no one can. If you panic in the middle of the crisis, you actually, in the long run, you tend to lose a lot of money, as the chart on the right shows. 6 months after a big crisis event, most times the market has actually recovered very, very nicely. So let's unpack this war in Iran and what it means, because I think too many people look at it and go, okay, Trump will stop it when he wants to, or whatever. But it's not as simple as that. And I think if we understand the different players, and there are a lot of players in this conflict. Some have been drawn into it, some started it, and they've all got very different agendas. And I think if we look at it from their perspective, it'll give you a better understanding of what the possibilities are. And the timing is the impossible thing to judge. But when you read news flow and you read events, you can sort of understand what the different players are doing. So the two key players are obviously America and Iran, completely polar opposites of what they want. America wants to dominate, full of bluster. With Hexas and Trump, they just want to annihilate. And you read his Truth Social again last night, and the Navy's under the water, the Air Force doesn't exist. And it's the best military victory in American history. But that means nothing when your so-called enemy just wants to survive. And by surviving, Iran wins. Because they have actually realized they've got more power than they thought they had beforehand because of the Strait of Hormuz. And they will weaponize that strait going forward. So they know that militarily they cannot win. But if they just keep America on the string, America will eventually, lose interest in the war, and Trump will be forced to sort of withdraw and actually give some concessions. So those are the two different scenarios that they are coming from. One wants to survive, and one wants to dominate. Then you look at all the other parties in there. So Israel is the third big player in this debate. They were key in getting this war started. And if you listen to previous secretaries of state and secretaries of defense, Netanyahu has been trying to get this war going for decades. And he's been telling the Americans that Iran will fall over in a matter of days, if not weeks. All we need to do is go in. So he doesn't want to back down. And I use the word he because I think it's very much more Netanyahu than the state of Israel. He's got corruption charges over his head. He needs this war to continue so that he can carry on being the leader of the country. So he will put in all sorts of pressure on Trump and on the region to keep this war going. You then have all the other Arab states, the Gulf states, the UAE, etc., Qatar, who have realized that they are a lot more vulnerable than they first thought. They thought having American bases on their land, they would be very safe, but it's been anything but the case. The drones have come through. There have been far too many attacks on these regions for their comfort. Many, many expats have left the region and gone back to America. A lot have come back to South Africa. A lot have gone back to the UK because the reason that they worked in Dubai and other cities like that was it was a fantastic tax haven. You were paid a lot of money for it, and you were safe. There wasn't much else going for it. It's a very hot place. It's in the middle of a desert, but that safety was a key element. And now you've taken away the safety element, and people have realized how vulnerable they are with their desalination water plants, their power plants, etc. You just need one or two drones to hit the region, and those cities are in big trouble. And we also saw with the airplanes. So the Gulf states, they want Iran to be neutralized militarily, and they are keeping some pressure on Americans to not just to withdraw very, very quickly. So they've got a completely different agenda. Theirs is an agenda of survival, not domination. Then the Russians have loved this. It's been a distraction for America. It's been a distraction for the world. They have got a temporary lifting of sanctions on their oil, so they can fund their war effort in Ukraine again, as well as most of the missiles that were heading towards Ukraine have now headed towards the Middle East. So it's made Ukraine a bit more vulnerable. So once again, there's another party that wants the war to continue for their own needs. And I think the country that holds the key to this whole thing is China. Xi Jinping and the Chinese, as we saw with the summit of the weekend, they are 10, 15 steps ahead of the Americans and actually most countries in that regard. They plan 10 to 50 years ahead, not 4 years for an election cycle. We saw that in the different presentations and speeches over the weekend. And they had been stockpiling oil. They've got the largest stockpile of oil in the world at the moment, thanks to all the Iranian oil that they've been buying for the last couple of years. So they're not too fussed about this war for now. What they do need is America to get a bloody nose, because then strategically that's very good for China. So they also want this war to carry on for a while, but equally they want the war to end in a couple of months' time, because their economy is actually, it's a classic K-shaped economy. Their exports and AI and IT are rocketing through the roof. Their consumer spending and property market is actually going down south terribly. So the exports are keeping them alive. So what they don't want is this war to go on long enough that we're going to a global recession, because then obviously the Chinese economy will battle. So it really is a balancing act that Xi Jinping and the Chinese are playing, but they have got enough clout to actually almost call it and come in as the mediator and say, okay, enough's enough. Trump, you need to concede this. Iranians, you need to concede this. Gulf states, you need to be able to live with the outcome. And I think their standing in the world will rise once this deal or this war comes to an end. So very different parties with very different ideas. Finally, South African emerging markets, we've got no say in the matter. We are price takers, and we will just have to make do with what comes our way. And for now, it means paying a lot more at the petrol station. It's suffering with a lot of volatility, but equally with that volatility does come opportunity. And when the war comes to an end, we will be in a much better space to actually take advantage of the opportunities that come thereof. So there's no one simple solution. There's no one simple desired outcome. There are many, and I think we need to keep that in mind when we look at the crisis. So let's bring it all back into South Africa, and what does it mean for our markets and our macros? First of all, this is the rand. This is the trade weighted. This is the US dollar against our terms of trade. And terms of trade are very, very clearly just everything that we export divided by everything that we import. And whole of last year, everything that we exported, platinum, gold, etc., was going up, and oil was coming down. So it was the perfect environment for South Africa, and hence a very strong rand. Now, with the oil price shift and a bit of a dip in the platinum and gold prices, we can see that whole trend came down. But for once, we haven't diverged from our terms of trade. Normally in a crisis, South Africa is the proxy to risk off in emerging markets. Because our fundamentals are so much stronger this time around, we've actually behaved exactly in line with our terms of trade and our macros. So we are not being punished anything extra that we did in 2008 and 2016, all these other times when markets went a bit wonky. So that's a bit of positive news to take away from this. And we are now bobbing between 16 and 17 bucks. It's not a major crisis. Gold is still holding up there, okay. Platinum's still okay. The good news is coal has jumped quite a bit due to this crisis, and we will start getting revenues from the coal exports, and thankfully we're actually getting them out the ports as well. Our port authorities are working a bit better, so it's not doom and gloom. Our terms of trade are actually respectable, and the currency is respectable considering the crisis that we are in. The really bad news, however, is the inflation outlook. We were in such a fantastic space. Lesetja Kganyago and the SARB had done a fantastic job. They had anchored inflation at the lower end of the band, and then they had got National Treasury to change the target to 3%, and we were there. We were done and dusted, and the average for this year was going to be about 3.1, 3.2% inflation for the entire year, which meant that we were going to get a cut in March and another cut in next week at the MPC meeting. Obviously, that has been turned on its head, and we're now going to expect a rate hike at the MPC meeting next week, and probably another one in July. So a complete 360 turn on what the outcome would have been on interest rates and inflation. The average now is closer to 4.5%, and that's with some sort of resolution coming through later in the year in the oil price. But if you look at that right-hand side of the chart, you can see the sensitivity to inflation. You've got the rand on the top. You just read across and you see whatever the rand does, and you've got the oil price at the bottom. So obviously, if the oil price comes back into the 80s, then obviously inflation looks fantastic. But equally, if it stays 110, 115, 120, then we've got a proper inflationary problem, and the Reserve Bank is going to have to act a little bit more aggressively. So the bad news is that we will get rate hikes. Definitely one. I think the thinking from the SARB, we actually had a meeting with them last week. They're not desperate to be aggressive because they do realize this is not a demand-led inflation, which is obviously the worst one. Yeah, it's when consumers have got too much money and inflation becomes a bit of a problem. This is cost push from the oil price, which means that there's some demand destruction already. So the oil price itself will do some of the SARB's work for them. So we don't expect an aggressive cycle. We expect a 25 basis points hike next week. And then they will go meeting by meeting. Like when we look at our portfolios, we react to the information that happens. If a peace deal happens, that'll probably be it. But if this war continues and the oil price is above $100, then we can expect another rate hike, probably at the July meeting. That was the really bad news and the sort of negative change. The good news is the gold and platinum prices are still at levels that will be very profitable for South African companies and exceptionally profitable for National Treasury. So even though we've come off from the extreme highs that we saw end of last year, beginning of this year, the royalties and profits are still going to lead to bumper gains for National Treasury. So last fiscal year, we forecast that National Treasury we were going to get about 27 to 30 billion rand. They got their 27 billion rand extra. The number for this current year was closer to 1890, but with the sort of roll down of gold and platinum, that number's sitting at about 75 billion rand that National Treasury will collect in royalties and tax on profits of our mining companies. And you can see we've broken it down per mining company. Our equity guys, actually drill down all the way to company level, so we know where the money's going to come from. And the really good news is that this number is not in the budget. So in February, when Enoch Godongwana stood up, he didn't say, okay, we expect 60, 70 billion and we're going to spend it accordingly. He left it out completely. So some of the petrol relief that we've got will come from this. So there's not going to have to be a scrimping where we're going to get the money from. So it's just a little bit of cash in the back pocket of government. And that's why the market in South Africa has actually calmed down. If you look at the bond market in South Africa and the Rand this month, we've been one of the better performing emerging markets out there because our fundamentals are a little bit stronger and we're a little bit more resilient than we have been for many, many years. And we're a little bit more resilient than quite a few other emerging markets at the moment, thanks to what is coming out of the ground and what we are managing to sell. But we've also got a couple of challenges with our politics. We had the Phala result of the court case. As expected, the president is taking that on review. That is likely to put it on the back burner. And after a month or so, I think you won't even read about it. Some of the opposition parties might try and bring it up in the electioneering, but it's going to be not much of a story for a long time. It's going to get into the court process, and that's probably a 18 months to 2 year process, and we'll forget about it until the courts rule on that original report in probably maybe late next year. But the local elections are going to be very interesting. They're going to be very different to what we've ever seen before. 4th of November is a key date for South Africa. And it's a key date because there are certain metros that need change, are in desperate need for change to survive. We've all seen what some of the streets in Joburg look like, Ekurhuleni, eThekwini. There's been mismanagement and really shocking service delivery for too long, and change is needed. And you are seeing that by the candidates that the parties are putting up. And a colleague of mine, Nkumi, coined the phrase, Joburg is going to be the epicenter of the debate. And you're going to see candidates there are going to be like candidates with the gravitas. The ANC haven't announced yet. We've heard a couple of names. Mcebisi Jonas is one name that we've heard as a potential mayoral candidate for Joburg. So I mean that's a big commitment from them. We've got Helen Ziller and we've got Herman Mashaba, and he's coined the phrase "the rumble in the jungle," because whoever wins Joburg is going to have such a big foothold into national politics in 2-3 years' time when we have the national election. That's how important that election is going to be. So you're going to see a lot of focus in Joburg. I think that's going to be where most of the campaign money is going to be, because the winner there will have such a big advantage to actually show that they can change perceptions of voters' behavior going forward. Other regions to have a look at, I think it's going to be very regional. I think Cape Town's going to have a bit of a fight on their hands with the Patriotic Alliance, but they should be, the Western Cape should be fine. Eastern Cape and Limpopo are born, bred, and safe as houses ANC. If you look at the by-elections, they are solid ANC, no change there. The other really interesting debate is going to be Inkatha Freedom Party and MK and DA in KZN. So Durban's going to be a big fight. MK, as we know, won 40-odd% of the vote, but got zero power in KZN. As we all know, the reason that most of these people are in politics is for the money. It's not to do good. And there's nothing worse than winning 40-odd% and you've got no power, you've got no budgets. We've had sight of some of their strategies. They are targeting 13 to 18 municipalities in KZN. That will give them access to billions and billions of rand. So if they win 14 municipalities, they will manage 25 billion rands worth of budget. If they win 18, they get 33 billion rands worth of budget to manage. So there's a lot on the table in that area, in that region. So that's another key area to watch. So I think what you've got to look at is Gauteng and KZN are the two big political battles that are going to happen later this year. So the good news is IFP seems to be sorting out their leadership structure. They announced today that they've come to an agreement on who's going to be the candidates, etc. So you're not going to see a split. You need some sort of consolidation. They've done a fantastic job in turning KZN around within the coalition. So long may that continue, because that's a very key part of South Africa. And we need KZN to work. That's where our big ports are, Richards Bay and Durban, our biggest port. It's a big tourist attraction. So it's important that region does well. So just to remind us of why we've actually behaved okay in this crisis. People forget there's a lot of bad news out there, and quite rightly, I'm not going to sugarcoat it, but we mustn't forget the good news that has happened and how we've become a little bit stronger as a country, and we're slowly starting to rebuild this economy that we can actually get to where we need to be in a couple of years' time. But last year, S&P upgraded us one notch, and there was huge expectation that they would do another notch this year because they kept us on positive watch. Moody's came and saw us literally 2 days after the war started, and you could see they were quite deflated because they'd come here almost to rubber stamp a ratings upgrade as well. And when we engaged with them, they said what happens in a time of war is that they pull back from countries unless the countries are in the war, and they actually focus on different companies around of who's going to be the most vulnerable. So we're not going to expect too much from them while this war is going on. The grey list has come and gone. I think our financial system is quite a bit stronger as a result. Eskom, we hit 367 days of no load shedding yesterday. So that's a good trend that we should see continuing. They made a profit for the first time in over a decade. and they are producing more electricity than we actually require. And the amount of renewables coming on stream now is quite incredible. And we're going to be energy sufficient in about 2 years' time, even if we grow 2.5% to 3%, which we need to get to. So that's very good news. Transnet continued to improve. This I think is where the needle's moving the fastest, because Operation Vulindlela started with Eskom, and now we've sort of stabilized, and that's working well. Transnet's in that fantastic stage where it was so bad that any improvement is quite a big improvement. So we saw ICTSI won their court challenge. They moved into Durban Port in January. They're going to spend billions in getting that port up and running. We've seen the train operators. As at yesterday, Transnet Rail Infrastructure Manager awarded. So they're given a concession to 11 rail companies. They officially awarded the contracts to these companies yesterday. And we will start seeing private operators on our lines. That should improve the rail transport by 24 million tons a year in the first couple of years, and that should grow to about 52 million tons in about 3 to 4 years' time. There are already locomotives, etc., on their way. We will start seeing non-Transnet vehicles, trains on our lines. The ports were the best performing in close to 15 years. In the last financial year, we saw movement of freight up 9% on the previous year. So as I said, it's off a low base, but we are seeing these are big increases. And Durban Port Authority also signed a contract with HPT, which is a private company, to build a fresh produce facility in the Durban port to make sure that our fresh produce can move out. Grindrod has done a very similar operation here in Cape Town. So we are seeing investment, we've seen improved efficiency, and we've seen a complete cleanup of the corruption and the horribleness of our second biggest parastatal, in showing that we are getting the cogs of the economy moving again. So where does that leave us in the global world? Because there's a lot of volatility, a lot of noise out there. So America remains resilient, albeit very AI focused and AI centric, but that economy is still ticking over, which is good for global growth. What we've seen is they've priced out any chance of a rate cut, and there's now a new Fed governor who's just come in, old Kevin Walsh, and the expectation is that rates are on hold in America. So there's no rate hike priced, but rates are on hold until next year. Europe has hiked, and they're likely to hike again. They are worried about inflation. Australia hiked for the third time yesterday. They're also very, very worried about fuel prices. Japan has hiked, but not enough. Their market is telling them that they're a little bit behind the curve. And as I mentioned, China is doing very well externally, very well AI, but not so well in their property market and their consumer market. So a very mixed sort of economy. And the Gulf regions, this is the opportunity for South Africa. So we've got a colleague that lives out in Abu Dhabi, and the consensus from him and from colleagues of mine in America is the big sovereign wealth funds, the big pension funds in both America and the Gulf state have realized that they are overexposed to American assets. It was almost like a lazy allocation. It's an allocation that the regions, the volatility, what Trump has caused in those markets has led them to actually get a little bit nervous. So they are all saying the same thing. They want to diversify. And when they say, where do you want to diversify to? It's not into the global, the G7 countries. It's into the bottom right-hand corner. They're into emerging markets. You've seen more and more inquiries of these big funds wanting to learn a bit more about South Africa and Brazil and Poland and Hungary, etc. So when this war ends, the emerging market universe is actually quite well placed to take advantage of the structural shift that we are witnessing and living through at the moment in the world. So finishing up on South Africa, we've had two fantastic years in the bond market, 17%, 24%. The chart on the right just shows you how attractive South African bonds still are. You know, way above cash, way above inflation. So you are still being compensated for the risk to be in a country like South Africa. And as I pointed out, we are starting to see benefits of the structural changes that we're having. We've still got a lot of challenges, but there are some improvements that an investor in South Africa is, number one, compensated, and number two, there is the glimmer of hope that as the world sort of changes, it shifts more towards emerging markets, and South Africa is well placed to take advantage of that. Thank you very much.
Thank you so much, Malcolm, and thank you, Ray, for both of your presentations. Those were very, very insightful. There is a question in the Q&A, which I'll give to Ray, and then I'll just expand on that question because you did touch on it briefly in your presentation, and there was a slide on it. The question had to do with whether AI is a bubble, which you said you're unsure whether it is or it isn't, and the likelihood of the impacts of that being similar to kind of a dot-com bubble. But the expansion that I would like to make on that question is, I suppose what it speaks to is that there's a lot of concentration and bifurcation and risk prevalent in global markets, whether it's AI, geopolitical tensions, there's a number of risks and the market seems ripe for volatility. And I'm referencing your pure equity strategy. How do you both participate in market upside, but also aim to protect client capital in a volatile environment like we're presently experiencing?
Yes, thank you, Lisa. And I think those questions are obviously linked because in terms of protecting and participating, AI does seem to be at the center of all that. Is AI in a bubble? I don't think one can make that blanket statement about all companies. Certain sectors of the market, when one looks at some of those semi-memory names, you're up 3,000%. One has to question, how long can that continue? But to give an example, Meta, as we all know, the owner of Facebook, they just posted revenue up in the last quarter, a week or so ago, up 30%, revenues up 30%. So they're still making money. Profits are still doing well. However, the amount of money that is being spent, as I put up, is mind-boggling. And the question is, are they going to overspend? Now, whenever you have a major structural change, I think AI will it will change the world. But the problem is, will there be overspending? Will guys overshoot? Spoiler alert, they almost always do. They almost always overspend. The question is, are we there yet in terms of the overspending? And when you have a huge amount of capital rushing into an area, the question becomes, okay, when do I need to exit this party? When have I had enough punch and I've had my fun and I need to go? And that's the very tricky part. So I definitely wouldn't put all one's eggs in one basket. Or would I have 16, 17% of my fund in semiconductors? No, and I don't. It's hard to say that when things have gone up, thousands of percent. But I think, it's all about portfolio construction and diversification. We're looking for, unrecognized beneficiaries of some of the spend. Energy names and electrical companies are one of them. But then things that aren't correlated, that have been, ignored, forgotten, and various businesses. They can be, everything from short-term insurers to even staples companies. And Berkshire Hathaway, Berkshire Hathaway is one of the largest owners of energy infrastructure in America, and AI is going to need a lot of energy, yet it has underperformed. So it's about really portfolio construction and diversification. I think it's too early to say whether it's a bubble, but I think in certain areas things are looking very frothy.
Thanks, Ray. So I'll want to pose a similar question to you, Malcolm, about participation and protection. I mean, we appreciate that local fixed income as an asset class is very attractive on a risk-adjusted basis, and historically has also been very attractive on a real returns basis after inflation. You know, as South Africans, I think it's a welcome relief that there's a lot of kind of positive momentum in our outlook. But I think the simple truth is that for a lot of clients, when they see that component of South African bonds or South African fixed income on their statement or within their portfolio, there's the perception that it's not necessary, like how conservative is this asset class in my portfolio? And so if you can maybe just unpack that a little bit, and then also just maybe the risk-adjusted returns in the asset class, and where you are finding the best opportunities.
Yeah, thanks, Lisa. So a pure bond fund obviously is a little bit more full voltage than an income fund, and there you've got to have a stronger stomach. But that graph that I show, that over the last 7-8 years, the bonds have never given a negative return because of that yield. You're earning 9.5–10% at the start of the year. So you've got a huge buffer over cash and over inflation. And even when you have a terrible month like March, where the market lost 7%, well, guess what? We've made most of it back. And January and February were quite good. So it's important in our income phase, we do participate and protect. So we participated very nicely in the beginning. We took risk off when the war happened. And the way that we do that is, obviously, you can sell some of your assets, but we also have optionality all the time that automatically takes our risk down when something unforeseen happens. You'll always have some foreign exchange in your account, in your portfolio, because as we all know, the rand is the first one to go. So if there's a wobble, the rand will sell off first, followed by your equities and your bonds. So that gives you the protection that it almost gives you time to sell your other asset classes, and then you can neutralize your FX. And then South African credit has been a fantastic place to get value for our clients, and consistent, very low vol. So we invest in investment grade, good quality credit, a diverse portfolio. It's not concentrated at all, and that gives us 1.5% over government bonds. So you actually been even compensated more than you are in a government bond with much less volatility. So we maximize the yield in the portfolio so that we get almost more protection than you would have if you just had sort of like normal bonds in that fund. And that way we can give you, a comfortable inflation and cash beating return consistently year in, year out, and touch wood, no negative quarters for this fund.
Yeah, it's a great outcome, as you say, on a risk-adjusted basis, and that buffer really, really does provide you with that lower volatility outcome. We've got 1 minute left. I'm going to squeeze in one last Q&A, which has just popped up. Malcolm, what's the probability of a bond sell-off globally?
We're in the throes of one as we speak. The US, their long-dated bond broke 5%. The short-dated, the 10-year, went through 4.5%. The Japanese bonds are up. Gilts are up because the UK is, my colleague and co-portfolio, Pete Kent, calls it the EMification of DM. So the DM markets are behaving like we used to in the 80s and 90s. And just their politics is crazy. It's unpredictable. Their fiscus has been badly run. So we're in the throes of a sell-off globally at the moment. And that's why it's quite telling that South African bond market is actually up this month, where every other developed market is actually lost money. So there is that sort of differentiating that's starting to happen now, but we can't ignore it and go, okay, it's not going to be, we will continue to do well in that environment. That is a big risk, and that's why I started after Ray's comment, is that global is our biggest risk at the moment, whether it's politics, whether it's the war, or whether it's the pressure on yields on the upside globally.
Sure. Thanks, Malcolm. And I think it really speaks to the importance of diversification. And I think I'm sure we're all very grateful that emerging markets are hopefully going to have a longer time in the sun. And we are we feel very privileged to have partners like yourselves. It really bolsters what we are able to do for our clients. And yeah, I mean, as Ray mentioned, you can't predict the headlines because it's as unpredictable as the Cape Town weather. And fortunately, successful investing doesn't actually depend on predicting the headlines. It's really about the disciplines of diversification and patience and having a long-term perspective. So yeah, from Sterling's perspective, we always aim to balance both participation and protection and build resilient and diversified portfolios for our clients. And yeah, thank you, Malcolm and Ray, for your insights. We really appreciate having you on board, and to all of our valued clients who took the time to spend some of your morning with us this morning. Thank you for tuning in. And if you have any more questions, please feel free to reach out to any of us, to your advisor or anyone that arranged the call, and we'll gladly provide you with an answer. Thank you so much to everyone for your time. Have a wonderful day.